Thank you for being here today. Thank you for attending the 5th Annual Real Estate Summit. I'm Linda Lee. I'm your president this year. Thank you so much for the honor to have the opportunity to serve you. Before the program started, I went to every table and say hi, and I truly meant it. I truly meant to thank you so much to take the time for being here to learn. As you all know, the market has recovered tremendously. If we look at the most recent August statistics that SDR had put together, internal single detached home compared to 12 months ago went out about 30%. Townhome and condo is about 35%. Our inventory, through good work of all of us in this room, the lowest point were about 3,200 units. I believe right now we're about in the low 6,000s. San Diego County closed in about 3,400 units a month. It's tremendous. And it's a great work of everyone in this room and all our realtor members. That's 11,000 members with Greater San Diego Association of Realtors. So please give each other a big pat in the back. Say, great job, you guys. Great job, great job. And I also meant it to finish the 2013 strong. I accomplished my 2013 production goal by August, so now I'm cruising. I'm definitely planning to finish strong through December 2014. I see so many mentors in this room. I see so many top producers, managers in this room. Thank you for all you do. I even saw one of the realtors that sold me my house, Gabby in the back. It was awesome to see, the realtor that helped you to buy your first home or second home. So thank you for being here. San Diego Association of Realtors is very proud for the education and services that we provide. And that's why we continue to do the Real Estate Summit. Today, there are about 600 of you here. We want to provide you the cutting-edge information, the market trends, where we have been, where we are going, from different diverse perspectives. I know we have Freddie Mac here today, my buddy Tony, and we have the city tax collector, right, Dan? County, okay. We have Leslie Epperton Young, who is one of my true inspiration. She is a California Association of Realtors Chief Economist, Vice President. Whatever Leslie says, listen to her. She knows her stats. It's just incredible. And I'm so honored for her to be here. The building industry, the academic, thank you for all being here. We couldn't possibly have this event today without our sponsors. So can I have the sponsors of the event or throughout the year, please stand and be recognized, please? I know Bank of America is here, CD Bank is here, Blue Fire Lending is here, some escrow company is here. So thank you. And look at the slides. You see all our sponsors and San Diego County Credit Union, absolutely. So thank you for being here. I also like to welcome our San Diego elected official here with us today. Could you please stand? And I know we have Assemblyman Rock Chavez and Santee City Vice Mayor Rob Menales. Rob, where are you? So thank you for being here. In addition, we'd like to represent, we also like to have a round of applause for our very hardworking staff because we couldn't possibly have this event without them. So please, Catherine, Mike Mercurio, Melissa, all the staffing, thank you. Yeah, we were up until about 2 o'clock this morning, emailing back and forth about today. This is our third meeting today. We start with the board director, then we roll right into the annual meeting, member appreciation. Now we have the real estate summit. There will be a question at the end, a question and answer question today at the end of our for our panel. If you have a question, you can text your question at the number that they put on the slide right now, and then your question will be displayed live during the Q&A, and you can also find a text line on your table tank cards. So now I'm going to bring our 2014 president, Leslie Kirkpatrick, and she will introduce our panels. Thank you.
Thank you. It's so exciting to be a part of this association. And you know, there's so many statistics and so many things online, and consumers are grabbing at these things. And that's a lot of information. But what we need is insight and knowledge. And that's what we're bringing to you today. So I hope you will help join me in welcoming first Tony Hutchinson, the Director of Government and Industry Relations for Freddie Mac. Tony? Russell T. Vallone II, President and CEO of Market Point Realty Advisors and Board of Director for San Diego Building Industry Association. Robert A. Young, Managing Director at Citigroup Global Markets. Michael Lee, Lecturer of Finance and the former Director of Corky Macmillan Center for Real Estate at San Diego State. Dan McAllister, San Diego County Treasurer and Tax Collector. And I always think the smartest girl in the room is named Leslie. So I'd like, but this one's really smart, so I'd like you to welcome Leslie Appleton Young, the Vice President and Chief Economist for the California Association of Realtors, who will be leading our panel today. So please, welcome them all.
Good afternoon. Good afternoon. Come on, you guys, this is economics, and so we're going to need a lot of passion and energy to have, no, we're not. We obviously have an absolutely fabulous panel. I'm so delighted to be back here this year to be part of your economic summit. And I'm here to learn as well. I mean, I can't imagine a more august group of people to talk about some of the things that we're really concerned about. So let me just tell you a little bit about how we set the next hour or so up. Over the last week or two, each one of us submitted 4 slides. Now, I'm the facilitator, so I have 6, but you know, it's only fair. No, everyone got 4 slides. And I kind of looked at them and arranged them in what I thought was kind of a reasonable order in terms of having a dialogue about where we are and where we're going. So what we're going to be doing is flashing the slides up on the screen, and whenever the slide matches the panelists, they get to talk about what's relevant in terms of the information in that particular slide. And then it's going to be open dialogue. So if anyone else on the panel wants to agree, disagree, add, elaborate, whatever, we'll get really down, I think, into some of the important issues. So with that, this is just a great experiment, and let's get started. So the first thing I thought, you know, I get asked this all the time, where are we in the current housing cycle? So the first slide gives, I thought, a great summary. This is from Tony, on where we've come over the last 4 years. So Tony, go ahead and kick it off with an overview.
Absolutely, we'll do. First of all, I want to say I'm a little upset they only have 3 slides in the deck, and what's up with that? But that's all right. That's all right.
I took it.
No, I think at least from Freddie Mac's standpoint, we are finally beginning to see a little bit of light at the end of the tunnel. So you know, we had a disaster for about 4 years. Over the last year, we've begun to see purchase money pick up. We were in a refinance boom for a good while. That's beginning to subside. We're seeing purchase money come back into the marketplace, and that's great. I mean, that's going to be what really drives the industry, at least as far as we're concerned, over the next few years. The one real positive for us is in our book of business, delinquency numbers have gone down. Obviously, the amount of the product that's being originated right now is a very good product. The consumers are very good consumers. They're making their payments on time, and that is great. We're beginning to see affordability throughout the country is relatively high. We know that there are constraints here in California, so don't throw bricks at me for saying that. I understand that there's lower inventory and higher cost here, but overall, throughout the nation, we're seeing a level of affordability that is reasonable, and that's because interest rates remain low. We probably expect to see those go up right? As the economy improves, we expect to see those go up. So, of course, there'll be a level of constraint there. Some concerns that folks have, and we'll talk about this more as we go, is that private capital is still mainly on the sideline. I think most of us believe in order to have a viable mortgage or housing finance system, you need to have more private capital come in. I think we're looking to see that happen. Once that happens, maybe things will be a little more robust and kick off. And one of the last things we'll touch on, I'll mention just with the opening slide, and we'll talk about it again a lot later, is the fact that a lot of the reason private capital remains on the side and the market, even though it's improving, is not improving as great as it could, is because of all the regulation and proposed legislation out there. I think one of the things that we're going to have to think about as a nation is how we are going to move forward. And the moment we make a decision on that, I think some of the stagnation in this market space will stop.
Great. Anybody want to add?
I would like to follow his
Absolutely.
last remark.
Yes, please do.
Go on, Russ.
Welcome to the People's Republic of California. You want to talk about regulations. I mean, regulations have, and this is all important to you because it's the building industry that builds your careers. Because the building industry doesn't build the homes, they're not there for you to resell. And in this environment, in the political environment that exists in California, in San Diego, think about it this way, $725,000 home, average price of a new home. About $150,000 to $200,000 of that is regulatory cost. So just think about what it would be like if we were someplace like Texas or Backwater, Arkansas, where you could build in 90 days without all that regulatory environment. Our housing costs would be down and our affordability would be much greater, and there'd be more product being built for these people to sell.
Great comment. All right, I think, the next couple of slides just to set the, kind of set the tone for looking at California, and then we're going to talk specifically about San Diego a little bit later. So as you look at home sales, this slide starts in January of 2005. You can see the peak of the market. You can see the bottom of the market in terms of existing single-family home sales in the fall of 2007. This slide does not look like the national data, so that's a takeaway that I try to emphasize whenever we talk. What's going on in California doesn't look like the nation, and what's going on in San Diego isn't going to look like the aggregate numbers for California, which is why realtors are such an important part of really understanding this mass of information that's out there and what's really important. I do want to make just a couple of points, though. The California market came booming back in 2008 and 2009, primarily because of investors. You had investors in the beginning of 2008 going into the Central Valley, buying homes at less than replacement costs, people thinking they were nuts, and they weren't. So investors are the canary in the coal mine, and I'm very, very bullish on investors, but I do think kind of when we circle back at the end, I do want to make a point. One of the things that I learned over the last 5 years is that if you don't have equity in your home, you're not a home owner. And I think the fact that you've got a market that's 30% or has been as high as 35% investor really does have some implications for how this cycle is going to play out. And I don't know exactly what it is, but I know that's something different than what we've seen in some of the other cycles. The other thing I want you to note is that for the last 2 years, the market has been fairly flat, at a much higher level of transactions, but fairly flat, and that reflects the inventory constraint that we've been experiencing. So year to date, for the state as a whole, we're actually down a little bit over 3% compared to last year, and it's not a demand side issue; it's a supply side issue. Now, this next slide is a really critical slide to just show how markets work. So when you look at the share of equity or retail transactions in California, in January of 2009, which is pretty much the bottom, near the bottom of the cycle, 30% of the closings were traditional equity retail. Now it's 85%. The short sales went from about 10 to as high as 25, and now they're back to about 10% of the market. And REO has plummeted over the last 4.5 years from 60% of the closings down to about 5% of the closings. So that's really the name of the game here, is the distressed market has disappeared. And then this is my last slide, and again, I only have 4 until the very end. I just wanted you to see how quickly things change in a 12-month period, right? So you've had this squeeze and disappearance in the distressed market. So sales of property in California priced less than $200,000 in a 12-month period, June of last year to June of this year, went from 32 to 19%. And the over 500,000, let me put my glasses on, went from, that doesn't help, 26 to 37. Well, whatever, you get my point. And the point I'm going to make later is that this has dramatically impacted that statewide median home price. And it's very important, I think, dealing with your buyers and sellers, that they understand what the true price story is. And it is being distorted by this big change in the mix of what is selling. Does anyone else want to comment before we go on to Russell on sales? Or okay, so Russell,
Well,
you're up.
I wanted to talk a little bit about the new home marketplace, and I refer to this as the Black Diamond ski run of housing activity and production. You know, from about 69,000 units back in 2005, you know, we plummeted to less than 10,000 new homes being built in all of Southern California. I got to put that into perspective for you. In 2005 and 2006, San Diego County was selling 15,000 to 16,000 new home sales. In 2011, less than 10,000 in all of Southern California. We started to see a bit of an uptick. We saw about a 46% increase in activity, up to about 14,000 sales. In San Diego, it was about a 35% uptick. The problem that we're facing now is when we started looking at where we thought the market was going to go the beginning of the year, because we had this great first quarter, you know, great 800 new home sales, paltry comparison to the past, but you know, the biggest number we've had in a number of years. We thought, okay, we're on our way. We're going to see about a 15% increase in activity, and then we hit the second quarter. And then all of a sudden, we saw that almost a 20% drop, and what we started to realize is that production levels have gone down so dramatically in the county that all the legacy product that was started in the mid to late 2000s was being sold out. And the newer product that was coming on at new land cost, which had gone up dramatically, at new regulatory environment cost, which had gone up dramatically, and prices started hitting above $700,000 to a second quarter average of $733,000. Now, how does that impact you? I think it has a positive impact to you, other than the fact you're not getting new supply. What you're going to see is a lot of those buyers, because of high interest rates, are going to be driven to you in the resale market, which will stimulate that market even more.
Excellent. Anybody? Great. I love the ski run. Oh, sure. Dan,
Let me
yeah.
just weigh in a little bit, too.
Absolutely.
If we look at where those national prices are in terms of growth, and we compare it to San Diego in June outpaced the whole country for growth in home sale prices.
Right.
If we look at where the foreclosure sales were a year ago, 20% of what we were doing. This year, 7% this time, and compared to last year. The other thing I think that's important to look at is that we've had a 19% increase in year-over-year sales hike since March of '05. I mean, it's the largest we've seen. So things have really moved quickly. They've moved fast. There's a tapering now because interest rates have started to spike about 1.5 points in many markets, and that has slowed and tempered the markets down. But our mission here today is to give you good news and let you know that things are picking up and looking up. And back to that first point you made about delinquencies, we see that where tax payments are concerned too. And that's really our primary barometer. This is the first year since I've been in office for 12 years that we have surpassed human body temperature, 98.6% in terms of collection rates. In fact, we hit almost 99% collection rates this year,
Very
which is
exciting.
unheard of.
Woo!
But it's hard. But this is hopeful and positive for the markets here, because in a market that's tenuous and in a market that you would otherwise think people are watching still every penny coming out of the recessionary period, they're still paying what they owe on time. That's good.
Right, excellent. Okay, the next slide. Oh, go ahead, Michael. Yeah.
Also make a point that when we talk about San Diego, California, or the country, we're talking about large aggregates, but even within San Diego, conditions differ very much geographically.
Right.
And so we certainly have seen that the coastal areas, because of land scarcity, really have come back almost all the way from where they were back in about 2006. You go out to the outlying areas where a much higher percentage of distressed sales. Now you're seeing a big rebound there because a lot of those initial distressed purchases are coming back on the market now. The flips are going through and some of the rentals are now being sold out. So you have to kind of disaggregate this and say, you know, different factors are impacting different parts of the market.
Right, good point. Michael, you're next, right? Is that your affordability? Yeah, let's talk a little bit about affordability in San Diego.
Okay, thanks. First, I'd just like to thank SDAR and Leslie for hosting this event on behalf of Citibank. It's great to be here. And I'd just like to mention that, being from New York, we're kind of in a state of shock. Not about real estate, but about pizza. I don't know if you saw a recent survey, but a recent survey was done, and it said that San Diego has the best pizza in the United States. We're still trying to come to terms with that in New York. On this chart, which shows mortgage affordability, so lower on the chart is more affordable, higher is less affordable. I thought I'd give you some perspective on the impact of rates and higher prices. You can see that on the extreme right, definitely, we've seen a deterioration in affordability due to the rate backup as well as higher prices. But in the context of history, you can see that affordability is still relatively good. So, while the affordability has priced some people out of the market, on a historical basis, we think prices, are still at pretty reasonable levels.
I just want to add here that my prediction is that over the next 2 to 3 years, housing affordability is going to again be one of the key realtor issues. So we've done this, we seem to do this about every 10 years or so. So just to prepare you, it's the first-time buyers, young new households. It's really tough. There are a lot of people that aren't participating in what has been a fabulous real estate market. So there's hopefully some things we can do about that.
Well, I think this is basically showing you the dearth of production and the impact that it has created. For all of those of you who can read the chart, the blue lines are population growth, and then the second set of bars, the sort of yellow, is housing production, and then demand and the shortfall. So over the last couple of years with our stellar production of housing, we've created a significant shortfall reminiscent of what we saw in the early 1990s or early 2000s when we started seeing job growth. So what we're really looking at, and to put it into this perspective, on average, you think about a housing unit coming into play for every 2 people added to the 2.7 people added to the population base. Well, over the last couple of years, what we've been doing is adding 8, 9, 10 people to the population base for every housing unit we've built. So what's the impact of that been? The impact has been doubling up. And then the worst nightmare of every parent with a grown child, that knock on the door, and the kid shows up not only with his laundry, but with everything else he owns, and he says, "Mom, Dad, I'm moving home." So we've had a huge boomeranging effect. So this shortfall in housing that we've had, along with all of these people who have gone back home and have doubled up, are going to have significant impact in the coming years as our economy starts to rebuild, as we start to see our job growth go from 6,000 or 7,000 jobs a year back up to 25,000 and 30,000 jobs a year. Those friends that have been living together are going to go, "I've had it with you. The parents are going to open the door and say, it's been nice living with you for the last couple of years, but you're 35, leave. And sure, you're going to see another impact and another demand generator hitting the marketplace just about the time all of the distress and everything sort of moves away. So it makes the opportunity for real estate even stronger.
Great, great. Anybody else want to?
Yeah, I'd
Yeah,
like to add to
Dan.
that. It looks to me, too, as if we've got some other issues, and this was addressed very, very well early on here about the fact that regulations, restrictions, almost forbid new projects from coming online on a moment's notice to meet demand. And so when you look at ramp-up time, not only are permits taking a long time, they're costly. The regulations that go along with them are costly. They're inhibitors, not pushers of
Right.
the agenda to get more units online. So we're looking more at repurposing. We're looking more at rezoning. We're looking more at redefining where we've been, what we've done, and how we're going to do it in the future. And I think there's some very good pieces out there and people who are addressing these kinds of issues, but on a limited basis.
Right.
And more, we're going to have to all face up to this whole issue relative to all communities throughout San Diego County in where we go, what
Where
we
people
do,
gonna
and how
live,
we do
right?
it.
Yeah, absolutely. Excellent. Okay, Dan, you're up again.
I am. And since I've covered every point on this slide already, we can out of respect for the SDAR time. Once again, thank you all for hosting this. This is terrific. But I do think we've got some other issues that all relate back to affordability. And you brought it up and you talked about it, both of you. It's something that's there. How are we going to meet the demands of the future? And with limited product in the marketplace, it's only a matter of time because of supply and demand practices that we see prices continuing to rise and further escaping the grasp of first-time home buyers.
Right, I think it's been many years since I've written a paper that says something about the NIMBYs, right, not in my backyard. And yet I think that really plays into all of this because the regulations, at least some of them, aren't coming out of nowhere. They're really reflecting the desires of the existing homeowners. I spoke up at a panel at Sonoma State in the last year or so, and that was a really big issue up there because people move to Sonoma because they want the rural. They want the cows and the great cheese, and they want no traffic, and they're opposing a lot of the even industrial development that would bring in jobs up there. So a lot of it, I think, is an educational opportunity to kind of show how this can be done in a very thoughtful way.
But the constraints are really there. I live in Encinitas, and they just had Prop A passed, which was in effect a blockage of more dense development. And it, in the discussion there, it was pointed out that there are certain affordable housing goals that as a community Encinitas has to meet. And how is that going to be done if you can't have more dense development? And the supporters of that initiative said, we don't care.
Right. Right.
I mean, I don't think that's something, I think that's something that is not unique here. I think every community throughout the country is beginning to fight to run into that. And in terms of just regulation overall, I mean, you've got a burden on lenders, you've got burdens on communities, you've got burdens on consumers, whenever you go through something like we just went through, and this is just my experience coming out of Washington, D.C. and dealing with a lot of the policy folks there, there's always this need or this there is always this desire to overcorrect and fix and make perfect. And unfortunately, you can't fix and make perfect. And when you do, you tend to add on a lot of these burdens that are going to cost our desire to have affordable communities, our desire to meet all of the constraints, all of the obligations that we want our community to meet. The key is you'll have to figure out what is it that we want? What is that balance? How do we get to that? I think we've struggled with that over the last 5 years coming out of the housing crisis. I think that's why we are where we are in terms of public policy related to housing reform or financial services reform or even just development reform, because we're still trying to figure out how do you get that balance. It is a heavy lift. There are a lot of people out there aren't going to be happy. A lot of people, I would say the majority of people are not going to be happy. The key is, and I always say this when I'm talking to groups about regulation or anything related to it, when it comes down to policy, it's not a matter of doing what is right for specific groups, but what is right for everyone. If we can do that, then maybe we can get to a place where then we can address affordability, then we can address some of these other issues. But I think that, having all of these regulations and issues will permeate our discussions for the next few years.
But I think, too, the books and the government codes are replete with lots of laws and lots of statements that have been fixed later through actions 5 years down the road or 10 years down the road, where people realize that maybe the pendulum pushed too far to one side. Right. I think of appraisers and appraisals as a good example of how maybe things push too far because it actually impedes the marketplace more than it helps the marketplace, right. At least in my view.
No, I'd agree with that. And I would say that at least from policymaker standpoint out of Washington, D.C., you tend to have that. So you do have that overcorrection where you are very heavy-handed with policy, and only over time when you have experience and see what the unintended consequences sure. are in a specific market do you begin to kind of whittle that back.
That's correct.
So no, I absolutely agree with that. Yeah.
We're in agreement.
All right, and this discussion is an excellent segue into the next topic area, which is really about inventory and why is it so low. So I have the first slide, which is just the ratio of listings to sales going back to January of 2009 again. And, the long-term average for this data point is about a 6.5 to 7 month supply of homes on the market. So we're currently at about 2.9. It's been a little bit lower than that. Higher the price of the property, there's a little bit more inventory, but everybody's down significantly from where they were a year ago, although I would argue that we are seeing at least in the aggregate data, kind of a tipping point in the market over the last couple of months, and it has to do with the increase in rates and a little bit of a bump up in inventory. But I do think the inventory metric is absolutely crucial, and there's a lot of data points out there, but for me, if I had to pick just one thing to focus on to gauge where the market's heading, it would be inventory, because it leads the market by about 3 to 4 months. I know when I look back to what was happening at the end of 2011, beginning of 2012, it was clear that this market was really going to turn the corner and start accelerating, and you'll see it in the price data later on. But clearly, it's the lack of inventory in California. Nationally, they're talking about no inventory. Well, we've been in this recovery 3 years before the nation. We really have no inventory, and I think it'll be interesting to kind of hear what the panel has to say about why. Let me just mention one piece of information, and that is typically in past cycles, investors have flipped property. This time around, you had a preponderance of investors renting property, and they did it because it was upside on the prices, rates were really low, strong demand for rental units, and so on. So we do an annual housing market survey, and a year ago, 87% of the investor sales were rented out. I don't have the results for this year's survey. I'll have them in time for the report I do at the expo, but I'm sure it'll be down significantly because now you're seeing a lot more flipping. But my point is that kept a lot of properties off the market that would have been on the market in a different type of cycle. So anybody else want to talk about?
Well, I want to just mention the elephant in the room, which is the fact that we still have at least 25-30% of households that are at zero or negative equity. And when you factor in the fact that unless you're a first-time buyer getting an FHA mortgage, you're having to put down at least 10%. The proportion of people that still would have difficulty making a lateral move or even more difficulty with a trade-up type of move is still very high. So I think that that's a significant drag on inventory because a lot of those people are staying put and they're not putting their houses on the market.
Right. It's still a significant number, although it is down sharply from where it was 4 years ago. So I think the core logic number for just California went from 35% the fourth quarter of '09, and now we're less than 20%, but it's still 20%, right? And as you know, the price appreciation has certainly helped people come above water and gas for air, right? But some of them are doing loan modifications and refinancing. So again, it really has been kind of a sticky flow of those properties back to the market. Absolutely. Okay, let's see who's next.
Are we allowed
Robert.
to disagree?
Absolutely.
Leslie?
We
Because,
want
a
disagreement.
little pushback against Russ, but he's bigger than me, and I'm a little concerned.
And he has the best pizza, so.
So I couldn't agree with you more about inventory. That's the way we think about how to look at home prices going forward. We think inventory is the best near-term leading indicator of home prices. And as you can see, and as Leslie indicated, inventory has come down by a huge amount over the past few years. We think that that was a signal for the recovery we're now seeing. Furthermore, if you look back to 2004, you can also see that inventory bottomed around there. So inventory started creeping up, and that was a leading indicator to the crisis that we had 6-7 years ago. Currently, you can see that while inventory is down sharply, it is starting to creep up, and we're a little concerned about that. So we do think that that signals a slowing in terms of the home price appreciation rates we've seen so far. So we do expect home prices to continue to rise, but we think that these inventory numbers signal a slowing in that rate of appreciation, which might not be a bad thing given the affordability issues that we discussed earlier. Where I push back a little bit on the previous slide about demand is we're not really seeing that it's a demand-led recovery. I think demand has improved as unemployment has come down, but we're still seeing relatively slow household formation. Last read was about 750,000 per year, which is down sharply from more like 1.4, 1.3 million a year traditionally. And we still have all these issues of high student loan debt, unemployment still in the 7s, real median household income still flat. So the way we're looking at things is that it's really been because so many builders and other participants were rightfully so very cautious after having seen a couple of false bottoms, one following the homebuyer tax credit. Everybody being very cautious, we simply wound up in a situation where we ran out of houses. And that's how the recovery started. With inventory now starting to pick up, we expect things to sort of slow down.
So what do you think is the primary driver of that inventory picking up? Is that outside of construction? Is that
The combination of price rise and the interest rate rise is going to kick in as well. So in the earlier slide we showed around affordability, a lot of that deterioration in affordability was due to just price rise, people getting priced out of the market. We really haven't so far seen you guys have probably seen it in the bids, but in terms of the hard data, we really haven't seen yet the closings that reflect the backup in rates we saw in May and June. So those two things we think are starting to price people out of the market, and that's leading to slower inventory turn, and that in turn is going to lead to a slower rate of home price appreciation.
It does seem to me, just as kind of an independent observer though, that the banks, and I'm not meaning to pick on the banks, but since you're here, 150 basis points in 30 days is a lot of oomph. And based on anticipation of rates that still haven't been raised at the Fed level, it, to me, sort of signals maybe a return to old practices that aren't necessarily helpful. And possibly the banks moving too quickly to raise rates may have put some coolers onto the marketplace, either inadvertently or overtly. I'm not trying to pick a fight. We already established we have superior pizza. But any way you slice it, I think you got to come to the same conclusion.
We at Citibank are in favor of lower rates.
Heard it here first.
That's
Can I
awesome.
get another 2.5% loan? I guess we're going to talk about production. If I could ask you to click that button one more time.
I will.
So
and you can
always
talk
like-
about regulation again, too.
Thank you. Yeah, great. So I wanted to give you first a slide because as much as we in San Diego like to think we're not part of Southern California, we are. Thank God for Pendleton, but it would make a really great development opportunity just on the west side of 5. But, you can basically see from 100,000 permit activity, back in the great good old days of the mid-2000s, we were down to 29,000. Now, we've seen about a 38% increase in Southern California in the first 7 months of this year compared to the same time frame last year. That holds true for us in San Diego. Now, that upper corner slide is looking at San Diego, but instead of the first 7 months and then the rest of the year, the bottom is single-family detached product, and the top, the red bars, are multifamily construction. Let me tell you a few things that you need to learn about, given what we're going to see in development. Again, 35,000 lots in the entitlement process. Condos is a 4-letter word that is coming your way, and they are going to be here in great demand. Most of the activity that we've seen in terms of building permit over the last 2 years hasn't even been condos, though. If you look downtown and you see those 7 or 8 cranes that are down there, 5, 6 years ago, those cranes, which is now the national bird, or the official bird of San Diego, those cranes were building condos. Today, they are building apartment projects. And why is that? Because funds are still tough to get. When you start thinking about building a single-family home, you go out there and you can start a track of 3. You can start a phase of 5 or 6 units, and you can get the financing. When you want to start a 238-unit condominium project, you're all in day one. And there are not very many people who are still at this point in time willing to offer you the financing to build that monstrosity. So what you've seen is those monstrosities, though, you can get money to build apartments. Because the apartment market, even through all of this cycle, with all of the single-family homes that have gone into the investment pool, institutional rentals in this region are still averaging vacancy rates less than 5%. So you can see all of that new construction is multifamily apartments. But there's another 4-letter word you want to learn, and it's called conversions. Because what is happening today and over the last couple of years, we have built the supply for 2016, 2017, because a lot of that product is built by people who originally were going to build condominiums. But when you're building a condominium at $200, $300, $400 a square foot, and you can only get $175 a square foot, you don't sell it. You rent it. And as soon as this market continues to see, elasticity in it, you're going to start seeing some of those projects convert. And since they were built as condominiums, they do not have to go back to City Hall to get any entitlements. There's no discretionary. It's all up to them to say, here's your 90-day notice, here's your 6-month notice, whatever the individual municipalities require you to have. So you're going to see that product hit the marketplace in the coming years. Of course, the renters will be gone.
Anybody? All right, that's great. Okay, let me.
Oh, well, I got
This
one
is
more.
you again.
Yeah, I'm just lucky.
Excellent.
Well, this is the last time you get to hear from me because this is my last slide.
How many slides do you have?
I sent 15 and they only took 4. But this is supply of new housing, and this is why the new housing market is in such dire straits. The blue line is inventory. So back in 2006, there were 16,000 units of unsold inventory in actively selling subdivisions. There were 421 actively selling subdivisions in San Diego County with over 16,000 units of inventory. Fast forward to today. There are 81 projects in the county. There are less than 1,600 units of inventory. And then the red line is an annual slide of annualized sales quarter to quarter to quarter, looking back over the last 4 quarters. So back in 2006, when we were still in the cycle, there were about 22 months of inventory. It jumped up to 29 during the really bad start of it. Today, there's 7 months. And again, I sort of bring that into the equation because what you're going to see in most of the construction in San Diego in the future is condominiums and townhomes. You can't build those in 90 days. You can't build those in 120 days. You start talking 7, 8, 18 months in terms of the development. So the supply issues is really tight in terms of new home construction.
Right, very dramatic.
Do you expect those numbers to go up sharply?
No, because what's happening is there is no land. You know, again, we're the most regulated, one of the most regulated counties in California, in the most regulated state in the nation. But the land cost, the great part about the recession of the early 90s was when they took over, the RTC took over everything, they got rid of the land. So you went out and you were looking at lots that were selling at $80,000 in this region, and you could pick them up for $25,000, $30,000. And that actually started the economy going again, because instead of building the home based on an $80,000 lot, you built it based on a $25,000 lot, and it started things moving. Unfortunately, because of the RTC, all of the land holdings held today are privately held. And they're not in institutions that the regulatory environment can really have any say over. So a lot of that land, the guys just sit back and they go, why would I sell a lot that it cost me $500,000 to replace for $300,000? Because I just lost $200,000. I'd rather pay the carry on the land. Even over 5 years, it's going to be less than that. So new lots coming to the marketplace are going to bring about price points, in the 6s if you're in the South County, 7s if you're in the Central, and if you're on the coast, over $1 million. And those prices and that lots aren't there.
Housing prices. This is my last almost slide, and it really ties in with the earlier inventory and sales slide. And the story here is one, peak to trough, the median home price in California dropped 59%. We've never, ever seen that before. You can see very clearly in January, February of 2012, we're flat, and then boom, the market really started to take off, and that was the return of the kind of retail dominant market and a severe contraction in distressed properties. And as price appreciation accelerated, there were fewer and fewer distressed properties coming on the market. I do think it's important, again, to say that for most California homeowners, from July of 2012 to July of 2013, their home did not appreciate 30%, right? So there is a fairly sharp, and it's probably over 50% in that number, of an impact of just a change in the mix of what's selling. And it's one of the reasons why the Case-Shiller index is an important metric to follow, because they essentially are measuring the same market basket of homes, if you will, every single period. So it's not impacted by that change of mix. So when you get an annual shift in Case-Shiller of 8% or more recently 12%, you know that that's real, true price appreciation. And of course, San Diego is unique, right? And you've got these coastal markets where there probably are properties that have appreciated that much. And again, that's why the local overview that you guys bring to your jobs is what's so critical to making this market work, because every real estate market is different. So with that, again, it just shows obviously a very significant increase. And again, I do want to say most areas are still 20-30% off the peak in 2005. And I'm not saying that that was any kind of equilibrium whatsoever, but it is interesting to note that San Francisco and Santa Clara, so the Silicon Valley economy, is the strongest regional economy probably in the United States. I mean, certainly in California, but probably nationally. I mean, very, strong job growth, information intensive jobs, high income, and so on, and no dirt whatsoever, right? There's no dirt. So housing prices are almost at the point they were at the peak of the market. So that's kind of the leading leading part of California. So anyway, I just wanted to talk about that in terms of the kind of California prices, and then Robert, you can take it away with your analysis here.
Yeah, thanks, Leslie. This is the Case-Shiller Index that Leslie just discussed. So you can see, as she mentioned, that we are up sharply, but still significantly off the peaks. That's the red line is for San Diego. The blue line is for the U.S. We're expecting for this year home price appreciation in the U.S. to be about 13%, but we do expect, as we talked about earlier, that things are going to slow down, and we're expecting about a 4% increase the following year. In California and in San Diego as well, we're expecting outperformance. Not only is it in pizza, but in terms of home price appreciation in the second quarter, actually San Diego was #1 in the country in terms of home price appreciation at a 34% annualized rate versus 15% for the rest of the country. But we are expecting that outperformance to also come down, so we're thinking something like 19% in this calendar year, followed by something like 7% in 2014. I know a lot of people are concerned. I think people have been kind of taken by surprise how quickly things have come back in terms of prices, and that the sharp increases are sort of reminiscent of what we saw during the bubble. Our feeling is that, while, we are a little concerned about the incredibly rapid rate of home price rise, that, probably there are some reasons behind why prices are rising besides just sort of the bubble-like conditions that led to the financial panic, several years ago. Our opinion is that, while we wouldn't expect prices to go back to 2006 type levels, some of the reasons why prices rose, we think, are fundamental in nature. A good example is land scarcity. So in New York, people are now talking about micro apartments as small as 250 square feet, because a lot of people, younger people and some older people, prefer to live in downtown areas, closer to where they work or closer to cultural amenities. And I did some research on this, and again, I don't know, San Diego is on a hot streak or something. In the late 90s, you have a building on Beach Street called the Merrimack, and that was actually the first micro apartment built in this country, as far as I can tell.
And probably pizza delivery.
Right, exactly.
There too, I'm sure.
It's over a pizza shop.
Right, exactly. Okay, let's talk about the elephant in the living room again.
Well, picking up on what Robert is saying is, do we have a fundamentally driven market, or do we have, in large parts, still a fairly artificial market? And I would argue that there's a lot of artificiality that's still in the housing market, and there are three sources of that. First are the abnormally low interest rates. And we've had the Fed policy deliberately designed to really start boosting the housing market and getting prices back up, and they've been successful at that. But that's not going to last forever. We already know that the Fed is going to start unwinding its accommodative policy, particularly as it relates to mortgages. So that's going to be a stabilizer. We're going to return to more normal mortgage interest rates. The second we've talked about as well, which is the very high percentage of investors that are in the market. That's also abnormal. We're starting to see that slow down significantly, and so that's going to start turning us back to a more fundamentally driven market. The third has to do with the overhang still of the distressed inventory, and that's led to the very low levels of inventory, and a lot of people that would like to sell have stayed on the sidelines. As prices move up, that's going to take more and more of these people out of that distressed situation, and they'll be able to supply. So I think that if you look at all three of those factors, you would say that we're going to start moving towards a more fundamentally driven market. I agree with Robert and Russ with regard to the land supply being a very fundamental factor in San Diego, but we're not going to be in a bubble because rising interest rates, falling investor demand, and greater inventory are all going to moderate prices. And I think that's already started, and it's going to continue into the next couple of years.
Question. Will the Fed ever let someone who just because they breathe get a loan again?
You're asking me?
I mean, that was a big problem that we had for the bubble, and I laugh because back in 2000, early 2000s, my secretary bought a house worth more than the one that I bought, and she got a better interest rate than I did, and she breathed and I put 20% down. So the question really is that if mortgages not stay tight, but basically if you have to qualify for a loan, does that take away the problems with the bubble?
Well, I think that's one of the things that's going to also constrain the bubble, right? With all the regulation that's out there that makes mortgage credit that much tighter. The people out there who want to purchase or who that population of people who may have had the wherewithal to purchase but are now not just priced out of the market, but are pre-qualified out of the market, that's going to reduce the amount of people that can go out and buy, which actually I think is going to be a constraint on that bubble. I think over time, and we were talking about this a little bit earlier, when regulators and policymakers recognize that they have overcorrected and they've actually removed a good number of credit-worthy borrowers from the marketplace, not just people who were unable to afford or were taking advantage of products that they weren't savvy enough to handle or had the wherewithal to handle, but folks who have the income that in a normal marketplace they can afford a property. Once they see the unintended consequences of the overcorrection and come back and recognize they need to allow more people in the marketplace, then you'll have policy come back, and that I don't think will heat up the bubble, but will actually will actually give it enough fuel to exist. But where we are right now, I don't think we're in a place.
It's kind of an example of the dysfunction of government. You have one part of government through the Federal Reserve trying to stimulate the market by reducing interest rates, and another part of government through actions, also the Federal Reserve, but the other regulators that are making it more difficult for people to get those cheap loans. And so, I think what's going to happen is a balance out of that. We're going to stop stimulating interest rates. That's going to rise, but at the same time, we're probably going to start easing up a little bit on some of the qualification constraints.
Yeah. I would say you just characterized Congress. The right hand doesn't know the left hand. What?
In a very mild-mannered way.
Exactly.
Right.
I did not make that comment, by the way. I did not know.
Okay, Dan, I think we've got a couple slides from you now on the impact on tax collection.
Well, we've actually covered 2/3 of this, but let me just tell you that the top number is very important to look at because it's an indicator of how many taxable parcels there are in the county of San Diego. That number has been stationary for the last few years, almost a flat line. It's inched up incrementally, tiny pieces at a time. And as my colleague said here earlier, tiny pieces at a time. There are not huge housing tracts like there once were. There are not huge condominium projects with all separate parcels to be recorded and then sold by this great audience here today and ultimately taxed by the tax collector.
Right.
They do not exist. Instead, in some of these instances, we have one taxable parcels housing 600 apartment units, not 600 independent parcels. So that has really put a damper on the increase of taxable parcels in San Diego. Our revenues have crept up a little bit, but those are related to taxes and fees, about $4.55 billion in all for our collections. We estimate that the 980 will push up, hopefully over 981 when we start to issue bills in about 3 weeks again. Time-honored tradition, right? And we hope everybody will race down to pay during our 2 seasons of giving, right? We have 2 seasons of giving, right? December and April.
There we go.
I mean, come on. It was
Well,
a test.
I was impressed by the detail there, all the way out to $193. I
There
mean,
you go.
that's pretty cool.
We try to account for every last penny, but that's good. And then I think segueing onto the next piece, I think this is a statewide call to vigilance and caution. I think we all need to be cognizant of the efforts and the movements by some in Sacramento who would like to overturn Prop 13, to be blunt, which is pretty sad because I think it represents probably almost the purest form of a flat tax there is, and it's fair for everyone. Meaning, in my opinion, it is 1% taxed for the gross purchase price or the purchase price initially, and it doesn't matter whether it's an expensive home or an inexpensive home, it still is 1%. It's flat and it's fair for everyone. There is a movement to undo most of Prop 13, and if that doesn't fly, there's a secondary movement that would bifurcate Prop 13, leave protections in place for residential owners, but lift those protections for commercial properties in the state of California. I can think of no better way to turn our backs on business here and have businesses turn their backs on us and leave California than to lift the protections of Prop 13 on commercial properties. That said, I want to just segue into what, I'm sorry.
I want to point out one byproduct of Prop 13 that feeds into the points that Russ has been making, and that is that by capping property tax revenues through Prop 13, you've done two different things. One is that all money now flows to Sacramento, so you have less local control of things like redevelopment. Second, and more importantly, is that when new developments are put in place, the impact fees that are being charged on developers are a major part of that $100,000 to $200,000 price tag that you start with before you put any sticks into the ground. So if we're really concerned about affordable housing, we have to kind of deal with that issue as well. So it's not a unilaterally positive aspect, though I agree with the points that you're making.
The only other secondary point I wanted to make was reducing things down to a local level, and this involves all of you who are in the market on a day in, day out basis, and that is watching the fees, watching the bonds, watching the school bonds, watching some of the other issues that end up on property taxes and cause your buyers ultimately great grief and pain at tax collection time. And there are some that are done not necessarily in the best interest of long-term residents or owners of those particular districts. In San Diego County, for instance, there are 42 separate school districts that regularly issue bonds. No one argues with the need to issue bonds for capital improvements and projects that need to get done to educate our kids. However, we are definitely aware now, and many were not, about 2 years ago, of something called capital appreciation bonds. And these capital appreciation bonds have come back in many instances with payback ratios at minimum of 9 or 10 to 1. And in many cases represent millions, if not billions of dollars of payback numbers that is going to fall on the backs of local residents who buy those houses long term if they're not done in a positive way.
Great. And one more. Did you want to say anything about the investment pool slide?
Well, you can see the growth in our investment pool. Our office manages this past year about $7.4 billion. We manage money for about 110 different public agencies, but you can see the exponential growth dating back about 10 years or so. I, like you, have trouble, even if my glasses are on, reading that bottom number. But it's pretty impressive. This is all money that's managed locally for local entities, and our primary mission, of course, is preservation of principle, not to try to knock the lights out through extravagant, esoteric investment
You're doing
schemes.
much better than my investment advisor. Can I get your
We work hard.
recommendations?
We work hard, sir. We work hard. But I just want to let everybody know that that money is AAA rated. Standard & Poor's has consistently represented our pool, your pool, with a special municipal rating of AAA-F for its investments. And I think all due credit goes to the team and the staff. This is not a me venture, but a we venture.
Right.
And my staff does an incredible
Well
job.
done.
So.
Yeah, well done. All right, our last segment is about housing finance. And there are a lot of really, really hot, important issues, I think, that we all need to be aware of. Because if this ever was the period of the political economy, I think everyone might know that economics used to be called political economy way back when. And I think this is a period in our history where the politics and the policies that are set in DC are going to define mortgage finance. And as important as the mortgage interest deduction is, whatever might or might not happen to the secondary mortgage market, I think is number one, because you can't take a mortgage interest deduction if you can't get a mortgage. And I think this is very, very serious, and I'm very excited to have such expertise here to really talk about where rates are headed and what the political landscape is going to be. So we'll start with Michael, and we'll get into, I think, really a very serious part of this presentation.
Well, Leslie, economists are also known as practicing the dismal science. And unfortunately, my view of mortgage interest rates isn't necessarily what you guys want to hear. But there are a lot of factors that are going to drive mortgage rates higher and probably significantly higher. So as you all know, the Fed has been trying to keep mortgage rates down, specifically through their purchases of mortgage-backed securities. They're purchasing almost 60% of the net new issuance of mortgage securities today. And if current trends continue and they don't start easing off, that they'll be purchasing over 3/4 of the entire new issuance by the end of the year. Now that obviously is good for mortgage rates. It keeps those mortgage security rates down by boosting up the prices. But they have signaled that they are going to start ending this, probably going to start ending it in the fourth quarter. And to give you some idea of where I think rates probably should be today is if you look at the benchmark rate for mortgages, that's the 10-year Treasury. The 10-year Treasury is right now slightly under 3%. But if you look at where economists might think the fundamentals would dictate that rate, you would have a situation where the economy is growing at about 2% and inflation's running about 2%, so that 10-year rate really should be closer to 4% than 3%, and it's the Fed buying activity that's been keeping that down. If you then look at where mortgage rates would be with a 4% 10-year Treasury rate, mortgage rates typically run about 1.5 to 2 percentage points over the 10-year rate, and so that is going to put us into the 5.5 to 6% range, and I think that that's foreseeable within the next year or so. A couple other factors that are at play here is that there's been a significant widening of the gap between the rates that consumers get that you see out in the marketplace and those mortgage security yields that are influenced by the Fed. And I think that widening spread reflects a couple of factors. One is the cost of producing a mortgage, which gets back to our regulatory argument. It's gotten a lot more costly to produce those mortgages. Issues related to how mortgage servicing is treated for banks have increased the cost of holding those assets. And then we know that Fannie Mae and Freddie Mac have been increasing their guarantee fees, and that's also been a driver for that. So all these factors, I think, are drivers for higher mortgage rates in the near term.
It could be that while certainly there's a lot of anticipation for higher rates, given what we saw in May and June, the sharp move up, it could be that the market has already anticipated a lot of the tapering that the Fed is planning to do, and if that were the case, our call is actually for a more modest rise in interest rates. So we do agree directionally, but we think a lot of the impact has already been seen, and we're only anticipating a modest increase further.
So it sounds like higher rates, but maybe a little bit looser underwriting,
Yes, and
right?
that's going to
I mean,
exactly.
if you need a 750 credit score to get a mortgage these days, that does seem a little bit.
Certainly,
Yeah.
underwriting is a lot tighter. But I'm sure you guys are seeing it that things are loosening a little bit. We're seeing more conventional mortgages with 90 or even 95 LTVs being available with private mortgage insurance again. So I think things are going in the right direction, perhaps a little more slowly than people would like, but going in the right direction.
And just to demonstrate one more time that nobody really knows where interest rates are headed, and piggybacking off a story I think I told last year at one of these sessions, Einstein dies and goes to heaven only to be informed that his room is not ready yet. I hope you will not mind waiting in a dormitory. We are very sorry, but it's the best we can do, and you will have to share the room with others, he is told. Einstein says that is no problem at all, and there is no need to make such a great fuss. So the doorman leads him to the dorm. They enter, and Albert is introduced to all of the present inhabitants. See, here's your first roommate. His IQ is 180. That's wonderful, says Albert. We can discuss mathematics. And here is your second roommate. His IQ is 150. That's wonderful, says Albert. We can discuss physics. And here is your third roommate. His IQ is 100. That's wonderful. We can discuss the latest plays in the theater. Just then another man moves out to capture Albert's hand and shake it. I'm your last roommate, and I'm sorry, but my IQ is only 80. Albert smiles back at him and says, so where do you think interest rates are headed? All right.
Very nice.
Everybody has an opinion, right? There we go.
Okay, so now we're going to switch gears just a little bit. And we're going to have Tony talk about the legislative environment with respect to Fannie and Freddie. And it's, again, I think a very important topic.
Sure. And thank God I'm not in the comments. That's terrible. That's terrible. So one of the things that we've been talking about a lot, actually kind of on the sidelines, it's the whole idea of public policy and regulation. Well, one of the biggest issues out there right now is what is going to happen with the housing finance market. Right now, we are in the mode of trying to figure out how to revise it, rebuild it, if you will. And there are a number of trains of thought in Washington, D.C. on this. No one seems to be right. They've been trying to pull this together for the better part of 4.5, 5 years. We've had a number of iterations of legislation put through, but no one has really moved forward. We were talking a little bit before this, and part of that reason is because every time people think that they've got it right in writing, they realize that there was something else that they did not think of in terms of how this animal operates. And one of the things I tell people all the time is, if we take the guys who initially pulled this together in the 1930s and brought them here, they would have no idea what it was we were showing them. Literally, they would not. The system is totally different. And it's taken us from the 30s till now to get what we've got. So to be able to think that we can somehow pull together legislation in a matter of a few years and have 150, 200, 300 pages of legislation to fix it, to me, it just doesn't resonate well. But anyway, that's just Tony letting you guys know what he thinks. The current landscape in Washington, D.C. right now is there are two pieces of legislation out there that are the current minds of thought when it comes to what to do in the secondary mortgage market, and in particular, what to do with Fannie Mae and Freddie Mac. The first is the PATH Act, and that was put forward by the chairman of the House Financial Services Committee, Jeb Hensarling, out of Texas. Now, Mr. Hensarling is of the ilk that you do not need to have a government guarantee in the secondary mortgage market in order to have a viable one. There are lots of trains of thought on that, whether or not it can exist or cannot exist. And we'll talk about that a little bit. But his product is the one that says, hey, it's totally private market. Leave it up to the private market. They will tell you what the interest rates are. They will put the amount of capital in place that needs to be in place so that we can have a viable marketplace. A lot of pros with that, a lot of cons with that, but that's his thought. The second piece comes out of the Senate Banking Committee, and it's put together by two kind of unlikely friends, if you will, Mr. Bob Corker of Tennessee and Mr. Mark Warner of Virginia, Democrat, Republican, and Democrat, respectively. They have pulled together a piece of legislation where they believe that there needs to be some level of government guarantee in the secondary mortgage market in order to have a viable secondary mortgage market, in order to be able to attract investors, and one of their tenets is to ensure that there is long-term fixed-rate financing. That's one of the things that they want to do. Those are the only two pieces of legislation that are out there. The PATH Act has moved out of committee. Corker-Warner hasn't even been taken up by committee. One of the things that's going on in the Senate right now is that the Senate Banking Committee is actually finally giving a laser focus to housing finance. They had their first hearing yesterday on what should be done. They will have two more over the next 2 weeks. And maybe there will be something coming from there. There are all kinds of rumors about other legislation that will come from the Democratic side in both the House and the Senate. But these two are the only pieces of legislation that are really getting a lot of play. And it's really started, I would say jump-started, the conversation in Washington, D.C. about what needs to be done about Fannie Mae and Freddie Mac. Well, you might sit back and say, well, hell, Fannie Mae and Freddie Mac are, they're doing their thing right now. Everything is good. Why do we need to do anything about them? Well, one, Fannie Mae and Freddie Mac are in conservatorship. Conservatorship was not viewed as a permanent thing. It was only supposed to be temporary. So these two entities had to conserve assets so that they could continue to provide liquidity in the secondary mortgage market. At some point in time, they have to come out of that. There are some other regulations around them, specifically the qualified mortgage that originates in Dodd-Frank, related to the ability to repay, and then you've got the qualified residential mortgage also originating out of Dodd-Frank that has to do with securitization and how much skin in the game banks and lenders have to keep if they securitize MBS. There are constraints around there that are going to dictate or that need some answering, if you will, and the only way you can answer that is if you determine what you're going to do with Fannie and Freddie. So we're in a place right now where things need to occur. Some decisions need to be made. And one of the things that I will say to you, and I was going to save this for the end, when we're talking about different type of opportunities that you have, is, and Dan kind of mentioned it when he said, go out and talk to your assemblymen and your congressional people. You need to chime in and let the government know what type of mortgage system you want in the future. Right now is ground zero. We have a chance to shape it the way that we want it. We need to let people know what it is we're looking for. Do we need long-term fixed rate financing? Do we not? Do we want to have a very liquid market? Do we not? But those are the decisions that have to be made. And right now, we're just kind of floating along, and it's all right. But just like all the other constraints that are going to curtail the ability to build and sell real estate, if there is no financing, if there is uncertainty for investors, if there is uncertainty for lenders, if there is too much regulation on banks, costs will go up, people will step to the sideline, and the money that your clients need to purchase is not going to be there. If it's not there, then guess what? You don't get to move property. That affects your livelihood. It affects tax rolls. It affects tertiary businesses that rely on the selling and buying of property. And that tears at our growth as a nation. So we've got some serious things to think about. These are serious times, and we need to begin to tell our congresspeople exactly what it is we want. Because right now, they're kind of, I don't want to say they're operating in a vacuum, but they're hearing from people like me, a hired gun who, is told to, study something and come and give an opinion. You guys, and when I worked for the Realtors, so National Association of Realtors, this is what was great about working for NAR. You guys are on the front line. When I went into an office and said, hey, my members have these concerns, congressional offices listened. Because you guys deal with the constituents on the front line every day. You're telling the real story. A story that they can relate to and a story that they know they're going to hear about when they come home to have a town hall. When they come home for a working period and they're going to have you guys calling them or people there calling them. So I would say that the landscape right now in terms of public policy around housing finance, no one really talks about it. It's kind of a little bugaboo in the room, hiding in the back corner. Everybody thinks everything. That needs to be addressed. If it's not addressed, it's going to tear your house down. And again, like I said, these are the only two pieces of legislation out there. Just to let you know, and I was mentioning this earlier, when this whole thing kicked off back in 2008, I was getting probably 50 silver bullets a day from people telling me how we could fix this thing. And first of all, none of them would have worked. There were some crazy people sending that stuff, and that was absolutely absurd. Some of the stuff was ridiculous. But where we are right now are in some very serious conversations. Folks are trying to go down the road. Like I said, PATH Act, total privatization is already out of committee, looking to work its way onto the floor. Senate banking is looking for something bipartisan that they can work with a government guarantee. Those are two disparate conversations. Those are two different things, significantly. The key to remember, too, and I'll mention, is even though the House Republicans have gone full privatization, you've got a Senate Republican says no. So how do you have that conversation? So we're all over the board. We need direction. You guys can provide that. But that's where we are in terms of the landscape, not to throw cold water on an otherwise very happy event.
Tony, the next slide kind of segues into what I think is really the critical issue, and that is at what price private capital. And as you've watched someone like Bill Gross over the last couple of 4 or 5 years with PIMCO, it's like, absolutely, we're more than happy to buy mortgage-backed securities, but it would be nice if every mortgage in that pool had at least a 30% down payment, and I'd like a 300 basis point spread, please, to compensate me for the risk of owning mortgages. So the question is not, will private capital come in? I think it's at what price, and I think your next slide, if you want to get into
sure.
that a little bit, that's really the critical issue.
No, that is absolutely the key. Right now, if you take a look at the banking system, I think the banking system has, $14.2 trillion or something like that in assets, total assets. But 2.4 trillion is held for whole loans. That's only 16% of what they've got. So we'll call it 14.2 trillion is their capacity right now. The current mortgage debt outstanding is $9.1 trillion. So the current system, if they just absorb the 9.1, is going to have some level of issue doing that. You got to remember, banks also have other lines of business. They got to give you a car loan. They've got to hold They got to hold savings and deposits. They've got to give you consumer lines of credit. There's a whole lot of stuff that they need to do. So, one of the things that we have to think about is, do we want to have securitization play a role in the marketplace? If we're going to have securitization play a role in the marketplace and move a portion of that $9.1 trillion, then what are the rules of the game for that? How are you going to get private capital to invest in that? And you're right. So PIMCO and folks like that, we're hearing two things. Again, you've got the folks who say, hey, I've got money on the sideline. I want to come into the marketplace. But yeah, they're going to look for higher spreads, right? Because if there's no government guarantee, then all of a sudden there's more risk. Then you've got investors who are saying the exact opposite. They're saying, I've got to really think about what I want to do with my investment dollars. I would like to put it into housing, but in order for me to do that, I need it to be a little safe. I need to have some of the safety and security that we've had in the past. And if I don't have that government guarantee, then why am I going to bring on long-term financing onto my books? The key is, how do you get to that balance? The market worked well for us when we had a balance. And up until about 2005, 2006, there was a balance. Then things kind of got off kilter. How do we get that balance back? The other thing that we have to think about is, aside from the banks that are going to be making these and securitizing and laying off the risk, the end investor, outside of your pension funds, outside of your insurance funds, the majority of the product goes to wealth sovereign funds. A lot of those guys put credence into the fact that there is a government guarantee behind long-term fixed-rate financing. You can take a look at that now. As you'll see, Ginnie Mae, the spreads for Ginnie Mae over Fannie Mae and Freddie Mac are significant. The reason for that is Ginnie has an explicit government guarantee. Bank China, Bank Saudi, Bank England, they're sitting back going, hey, I'll take that every day because I know that if things go bad, I'm going to get paid. Whereas Fannie and Freddie, you sit back, they go, well, we don't really know because they don't know what they want to do with policy, and they've got good stuff. The quality of the product they're putting out is great, but what's going to happen in the next 5, 10 years? We don't know. And if you remove that, if you go to a strictly private, we don't know how big of an appetite those institutions will have for that. I'm sure there will be an appetite. We just don't know how big, and that remains to be seen. But again, that plays into the policy. Don't knock me down, Mike.
Just a couple things to point out. And you raised, the fact that things are really different now. And, right now we have a market where over 90% of all mortgage credit has a government guarantee. Ultimately, that's taxpayer risk. We saw what happened twice before with regard to government taking a lot of risk. The savings and loans blew up in the 1980s, and Fannie Mae and Freddie Mac blew up in the mid-2000s. So I think that all policymakers agree there has to be less government. And whether, as you raised that half bar shows is, you go from the Republicans who are basically saying it's just FHA and FHA is limited, so it's not zero government. Corker Warner basically says, it's going to be a government guarantee, but that government guarantee, if we're going to really change things, is not going to be free. It's going to have capital, significant capital in front of it. And that capital has to earn a competitive rate of return. And one of the problems we had in our mortgage market prior to the crisis was that nobody had really skin in the game and didn't have capital. Borrowers were getting 0% down. The lenders were selling everything without really retaining significant risk. Fannie Mae and Freddie Mac had almost astronomical leverage ratios. And unless we want to repeat the same situation that we went into before. We have to get more private capital into the game, and even if there's a government backstop there, and I think that you raised some good points as to why there should be one, and that's along the lines of what Corker Warner want to do. It's still going to be more expensive, going forward than it is today.
I would agree with that. I think it definitely is going to be more expensive going forward than it is today, because you're right. I mean, there was a lot of, and we talked about this a little bit earlier, where we were saying that if you've never experienced the 100-year flood, then you don't expect the 100-year flood to occur. So you keep acting as if home prices are going to continue to rise. You're going to keep reducing your capital amounts, your retained capital amounts, because you've never had to tap into them. Well, I can tell you this, I never thought that I would experience an earthquake in Washington, D.C., but I did, which was crazy. But, I mean, so we know these things happen, and I think one of the things that policymakers should work towards is to ensure that they think about those things, those disasters that can occur, and try to plan for them. You just can't be extremely definitive and detailed about it, because the moment you write something into a rule, all of a sudden you're stuck with that until you get that unintended consequence that we talked about earlier, and then it takes time to ratchet yourself back. There are some pros and cons to long-term fixed-rate financing. We talked about those a little bit. But again, it's up to you all. It really is. It's not up to me. It's not up to lenders. It's not up. Right now, it is out of our hands. Congress has heard from investors. Congress has heard from banks. Congress has heard from the likes of me. They've heard from economists. They've heard from everyone who has an opinion on this. Opinions are fine. The key is practicality is what we're trying to deal with. The folks who know about the practicality of the everyday business and what their consumers need and what their consumer wants are you. And you need to let the folks in Washington, or the folks who represent you in Washington, know that. I think you've got a great person in Linda Lee who works on the Conventional Finance and Policy Committee for NAR. She takes all of your opinions back. If you haven't shared your opinion with her, you should. She's a very good spokesperson there. And NAR does a great job for you guys as the CAR of getting your opinions out there. So you should share, not just with them, but with your congressional folks. But policy is significant. It means a lot. I know nobody likes it. It's not tangible until it becomes tangible. So.
All right, I think we're kind of getting towards the end of the program, and you may have texted in some questions. So we're just going to go through very quickly and have each of our panelists give them an opportunity to talk about a threat and/or an opportunity going forward. And I want to take the prerogative of the facilitator and start. And this is really for Linda. We do an annual survey where we ask realtors about their last closed transaction. And it's a very detailed survey. And for any of you that have received it and actually filled it out, I want to say thank you, because it asks very detailed questions about the last transaction. But I just wanted to share two slides, and that is to show Linda that the international buyer, the proportion of realtors who said they were working with a buyer who was not a U.S. resident, increased significantly this year to 8%, and the composition was 30% from China. I think that's all you, by the way. 9% Canada, 6% India, and 13% Mexico. So certainly in the opportunity category for San Diego, I would mention the international global real estate market. And let me defer now to the rest of the panel for a threat and/or an opportunity.
For an opportunity, I would say, following on your data on the international buyers, if you look at affordability internationally, the U.S. is actually, believe it or not, on the cheap side of the equation in terms of world prices versus incomes. So I think that and the potential for prices which have historically been a momentum type data series to continue rising. I think that's the opportunity. As far as a threat, I would say, if my wife starts worrying about tuition costs and pulls back on her spending, that could be a threat to the economy.
The opportunity would be if we actually could get housing finance reform finished so that we could get certainty, both in terms of the future of Fannie Mae and Freddie Mac and this regulatory morass that we've created through Dodd-Frank. So that's something in the next year and following on your comments, try to push policymakers to try to get something done so we could get more certainty into the market. The threat is that the markets don't react the way that Robert's forecast suggests, and that as we start unwinding our quantitative easing, things really kind of blow up and interest rates really spike. I think that's the threat.
I'm going to piggyback on what Michael said. The threat to me is not doing anything in terms of getting housing finance reform put to bed and dealing with a lot of the regulatory malaise that's out there. The longer that there's uncertainty in the market, the more people do not know how the market operates and don't know the rules of the road or how to play. When that happens, they step back. They're going to have extreme underwriting guidelines, or they're not going to participate at all. Once they know the rules, regardless if they like them or not, they'll participate. They'll figure out a way to do it. That's what business does. And the opportunity is just what I told you. You guys have an opportunity to shape what the housing finance market looks like in the future. Right now is one of the greatest times in American history where you can actually seize upon the ability to do something positive for the future for the country, and you actually will have a say. You need to take advantage of that. Believe me, I am. So you guys don't want me to be the only one talking. So.
I think the biggest challenge is production. I mean, again, we live in the People's Republic of San Diego. Right now, the policies have gotten a little bit better during the recession. We've seen a number of municipalities step up and have fee deferrals. Didn't do away with the fee, but let me pay the fees and the mitigating fees at the notice of completion as opposed to a building permit. Huge dollar savings there, which ripple through and impact the cost of housing. Haven't had a whole lot of talk about affordable housing, but you can bet your bippy that little beast is going to raise its head up here in the next couple of years. And what does that do? I mean, it impacts that price of that new home, which ripples through. And it also, in a lot of instances, stops that new home from being developed. Because as you look to the future, again, in San Diego, I want you to really understand that, it's infill. And the land that we are going to look at and develop those new housing units on, today probably has a use. It may be the crappiest little industrial parcel. It may be, the old body shop. It may be something, but that property is generating income and investment for someone. And to be able to translate that over into housing and become a new use and a new use for that, where we're housing people, there are costs associated with that. And as we keep adding on the regulatory cost and keep adding them on, it impacts that house, which has dramatic effect on affordability. And interestingly speaking, I yearn for the days when housing prices went up 1 or 2 or 3% a year. I think probably the worst thing that ever happened to housing is it became an investment vehicle as opposed to a home. And, so so sort of see that constraint in prices, because if we see prices do over the next year what they did between 2003 and 2004, that has long-term negative impacts on us.
From an opportunity standpoint, I think it's back to basics. Know your marketplace. This last slide tells a lot. There's a reason that our office now speaks 34 different languages in San Diego County. It's because the diversity factor has started to play into the reality of San Diego County's marketing needs. And my plea to all of you is to get up to speed on what's changed and what is changing, because the market is changing, whether you like it or not. The past paradigm of 10 years ago, 15 years ago, 20 years ago doesn't sell anymore. It doesn't work anymore. There are new buyers coming from all over the world to San Diego. They want to make San Diego a great home. Not only have they heard of our pizza making ability, but they are dedicated to finding a great place to live and work and play and raise their families. This is it. You guys are sitting on a gold mine. And I think diversity rules for that reason. The other thing that I think is interesting is echoing what the panelists have said today. Get involved. We have so many things at our fingertips now. I have to commend SDAR as well as the national organization for making your voices heard, and over and over and over again. It's a raining kind of thing, dripping on people constantly. It's not enough to do it once or twice or thrice. You need to get out there and beat the bushes, beat the drums, get things going. But if you look at writing, you look at faxing, you look at Facebook, you look at texting, you look at Twittering, all these are vehicles that are at your fingertips for the most part, and yet we all sit idle and we all wonder why things happen that we're not happy with once they happen. It's much easier, I think, as our friend from Washington said, to be able to get in there ahead of the game and ahead of time and make your voices and feelings known. So the threat is not doing those things. The opportunity is all of those things.
Great. You know, I don't want to, just one second, I don't want to stop without giving you a couple of book recommendations, which I do every year, and they're both tied into Washington and the political environment. So one of the things I think you might find very helpful is a book called Act of Congress by Robert Kaiser. Our Strat Planning Committee is reading it for this upcoming meeting, but it essentially starts where Too Big to Fail stopped and talks specifically about the Dodd-Frank legislation and how it happened. And I'm not saying it's a particularly uplifting book, but it's really interesting to see the world that Tony's talking about. On another angle, there's a book out called This Town, Two Parties, a Funeral, and Plenty of Valet Parking. And it's an expose of Washington, kind of starting with Tim Russert's funeral and going forward. But I read it in 2 days because it was absolutely hysterical and delightful. But again, a look at, you know, we can complain a lot about our political system, except that it is the best in the world, you know, and so it's important to understand it. And I think the great strength of the Realtor family is really understanding how important it is to be effective and do that. And kudos to SDAR for showing us how to do it. So I want to thank our panel. They were absolutely fabulous. Thank you. Thank you for having us.
It's always good to flash Friday the 13th up there to remind us where we are, right?
Room temperature is very important.
Wow.
Any hope for Harp 3? Probably not.
How much time do we actually have? Just take 3 questions. Okay. I can't read anything.
Yeah, about the REO shadow inventory maybe.
Yeah, REO shadow inventory.
Okay, who wants to take the REO shadow inventory question?
I can try.
There you go.
So the way we look at inventory is that, like I said, the change in inventory is the best near-term leading indicator of home prices. However, during the crisis, it became very difficult to measure inventory. Traditionally, like Leslie, we look at realtor listings. However, during the crisis, there were so many foreclosures coming out onto the system. The banks were dumping foreclosures onto the market that the numbers were misleading. So I think right now things have stabilized to the extent that realtor listings now are a good indicator once again. And furthermore, shadow inventory, while still high, there's probably about 1.3 million excess vacant homes on the available. While it's still high, it's coming down. And the direction, I think, is the key. So while we're a little bit concerned, we think it's going in the right direction, and so we're not overly concerned about it at this point.
Okay, good. Anybody want to talk about the commercial market? San Diego, anything on revenues or?
next question.
Well, I can talk a little bit about it. I think that it's a mixed bag. If you look at multifamily, that's the star of commercial, and we've really talked about the drivers of that. That is going to continue to be a strong market going forward, in part because of the affordability issues. I think office and retail are in some kind of a transition area. What we're seeing is that there has been a decline in the demand for space on the part of entities that rent office space. And that really reflects some of the technology trends that we're seeing in the market. I think that trend is going to continue, so that while we've seen a gradual strengthening of the office market, it's not going to go back to where it was, I think, in the early part of the decade. Similar issue with regard to retail is that we're going through a transition now with regard to retail and the use of space. And we're seeing that the strong power centers like UTC are continuing to do well, but we have a lot of the strip mall kind of inventory that's out there that Russ was referring to earlier. That's going to be repositioned at some point in time. It's probably not going to be retail. And so those factors are there. We still have a bit of an overhang of the commercial mortgage-backed securities market, where a lot of those properties, those were financed about 5 to 10 years ago, have to essentially roll their financing. And we don't really know what's going to happen because a lot of those properties are still underwater. So I think we're going to continue to see gradual improvement, but not any kind of great move up in the commercial markets other than multifamily.
Mm-hmm.
Okay, and the last question was from an investor who wanted to know whether they should buy an apartment complex or 12 single-family homes.
I think that you look at a lot of households today are living in that repossessed REO property. I mean, they got pushed out of they got kicked out of their home because they couldn't afford it. They still have the income, though, so they've ended up in that investor rental housing. As the market starts to turn, a lot of that property is going to be pushed back out into the for sale. And so all of a sudden you have a lot of households who are renting who are not going to be able to get the equity to get into a home for themselves or get the down payments or the credit or whatever they need. So I think as you look at that over the years, the continual demand for rental single-family housing is going to be stronger for the family. Those family households that are out there. Now, not a single guy or two single people or something like that, but the significant percentages of our families. When you look at San Diego County, I think it's like 57% owner-occupied. So there's a lot of people out there in the rental, and not all of them want to live in high-rises downtown.
Okay, well, I think we're out of time. Thank you all for sticking with us. It's been great. Thank you.
Yes, please. Let's give a round of applause to our panelists, and let's give Appleton Young as well.
Yeah.
I want to thank you all for staying. I know we went over time. The trade show is still going on, and we are celebrating our 100 years Code of Ethics. So there are cake right next door. Please help yourself. I do want to add the 10-second thing to what Leslie shared about the international buyers. The Chinese buyer in particular, they are right now trending. They have been trending towards commercial, and I want to say 6 months ago, I heard about they are looking to buy a winery. Yesterday, I got a call. They are coming over. I'll be meeting them Monday. They are looking to buy casino or build casinos here. So, it's very interesting what they are looking into. The world is opportunity. Go out there and close 2013 strong. Thank you again for being here. Happy selling. Bye-bye.